To welcome everyone to our webinar. We're going to talk all about the COVID-19 restart and achieving financial success during and after that time. So these are really difficult times. We want to thank you all for joining us and hope you get a lot of value out of the presentation that Accenture and River Logic have put together for you today. So before I introduce our speakers, just a few housekeeping items. The webinar will be recorded, so everyone's going to receive a link to the recording after the webinar. Feel free to share that link. The slides are available for download in the handout section of your GoToWebinar control panel, and we will save some time for questions at the end. So please submit any questions via the chat box. If for some reason we don't get a chance to address your questions, we'll be sure to follow up via email. So to introduce our presenters today, we have from River Logic, Pierre J. Berg. He's the one wearing glasses in the webcam. He is our Vice President of Professional Services and was one of the founders of River Logic and has successfully deployed dozens of optimization projects across a wide range of industries during his professional career. And then we have Pierre Mawet, Managing Director in Accenture's supply chain practice, where he leads the North America Integrated Planning and Fulfillment domain. And he also has been around for quite some time and has been helping serve clients in supply chain for 25 years. So thank you both very much for being with us. So before I pass it over to them, here's a quick agenda. Pierre is going to start off with some learnings and thought leadership on the COVID-19 pandemic, what we can expect as operations begin to restart, and the importance of keeping financial success top of mind during and after the pandemic. Then we'll do a quick intro of River Logic, including some of the unique features that make our technology particularly applicable to decision-making related to all the disruptions we've seen during COVID-19. And then Aaron is going to take us through a quick demonstration of the technology to show how it can be used in the context of a COVID-19 restart. And then lastly, we'll present a short action plan so you can understand what's involved in setting yourself up for this type of financial success during and after the pandemic. And with that, Pierre, I will pass it over to you to kick things off.
Thank you. Great. Thank you. Thank you, Shannon. And I want to thank the River Logic team for giving us the opportunity to present to you this morning. So good morning, afternoon, or evening, everyone, depending on where you are in the world. So we are now in week 5 of the COVID-19 lockdown, and things are still very unpredictable, and there's still a lot of uncertainty. We know that the lockdown was very abrupt, but we also know that the restart will not be abrupt. It will actually be very gradual, and we need to prepare for it. So when exactly are we going to be restarting? Well, that's a good question that we don't really know how to answer quite yet. It really depends on where you are again in the world, because we've heard last week that Austria was talking about restarting this week. We also heard that France has announced as of this weekend that we're still going to be in lockdown until May the 11th. And we now have 50 governors in the United States who believe that it's up to them to make the decision as to when to restart for each of their individual states. So we know the lockdown was very abrupt. But we also know that the restart will not be abrupt. It will be a very gradual process with still a lot of uncertainty. And there's always the risk that once we restart, we could actually go back into a lockdown if the COVID-19 were ever to resurface in the fall. Next slide, please. So before March, life was good. Life was very good. And then March will be remembered as the month where global supply chains were actually shut down. So pretty much overnight, we were instructed that we had to work from home. And so decisions had to be made the first 72 hours. Obviously, we had to assess the current operational and initial recommendations. We had to find out how we could actually work remotely, what kind of platform we could use. And then supply chains decisions were made within the first week, the second week, and then now in week 5, we're in this period where we've established, or most companies should have established, ongoing capabilities to actually work in this remote environment. Now is really the time to start thinking about what we do next, and what we're going to need to do for the restart. As I mentioned, the restart will not be abrupt, it will be gradual. There will be a lot of uncertainty in regards to where it's starting, where it's not starting, how it's starting. But it would really be a shame if companies had successfully managed to survive in the lockdown. You know, again, depending on the industry, some companies have, you know, a surge in demand, some companies have like almost zero demand. But it would be a shame if those companies had been able to survive the lockdown, but were not prepared enough to actually get ready for the restart. So the priorities really need to be set, and the priorities need to really be set right. Next slide, please. So when we look at the traditional model, the SCORE model that we all supply chain professionals are used to dealing with, plan, buy, make, move, sell, disruptions are really always part of supply chain management. There's always challenges in sourcing, in manufacturing, transportation, distribution, and sales. POs get canceled, lead times get extended, manufacturing lines go down, snowstorms impact transportation across the country, whether it's rail cars being stuck in a yard, or trucks not being able to go over a certain pass. And again, I've never seen a company where they had 100% forecast accuracy on their demand every period, every day, every week, or every month. So we're used to dealing with unpredictability. We're used to dealing with disruptions. And under normal business operations, those disruptions are handled with good tools and good processes, and in some cases, brute force. But for the most part, supply chains make it work, right? What is different about what's about to happen with the restart is that all of these potential disruptions, all of these challenges that we've seen around the SCORE model could all happen at the same time, and then all could happen every day or every week or every month for an extended period of time, while we actually restart in a very unpredictable and unstructured way. So it's very, very critical that companies, first and foremost, set their financial priorities, right? Is the priority around profitability? Is the profitability around cash flow? What is the profitability? What are we trying to solve? Because as I said just a minute ago, all of these disruptions could happen at the same time, and the traditional tools, the traditional processes, and certainly brute force is not going to make it work this time, right? There will be limited material availability, which will have an impact on what we can make. There will be unpredictability in terms of the lead times from the vendors, which means that we may have to create inventory buffers. But at the same time, if we have to create inventory buffers, that means that we have to spend cash. Will we have the cash to spend on the working capital? There will be pressure on short-term payment terms. When you think of a strategic sourcing team that's used to dealing with vendors and negotiating contracts with our vendors, a lot of times, you know, price is a very big, important component of the equation. Well, will price be the only component of the equation moving forward? What if a vendor offers a better price, but it has to be paid in cash immediately, versus another vendor that offers extended period terms, but at a higher price? Aaron will kind of walk us through what that actually could look like in reality. The same goes for manufacturing capabilities. What is going to be coming back online at what time? What about maintenance? What about those assets that have been idled? What do we need to do to make them work? Will we be able to have the spare parts that are necessary for the restart? Will we have the technicians, the workforce, internal or external, to be able to perform the work? And then on the transportation side, there's going to be a lot of variability as well, because where are all the empty containers that we need? Are they repositioned in the right place so that when we actually restart, we can start bringing some containers back? What about all that capacity that has been taken offline? So all of those dimensions, again, and the demand, which also is we're very unsure of as to what the demand is going to look like, all of those variables have to be taken into account. And therefore, it's important as we get ready for the restart, not to be thinking of them as individual silos or individual decisions, but really part of an end-to-end supply chain. And so running the supply chain from an end-to-end perspective is really what is going to be the difference between succeeding in the restart or failing in the restart. Next slide, please. In the coming months, companies will need to assess the financial impact of daily supply chain decisions more than ever before. And what that means is if in the first 72 hours of the first week, most companies have kind of addressed the supply chain challenges by assessing, putting together a command center or a task force, a lot of times without functional barriers, this is not the time to remove that. In fact, this is the time to really be thinking about how to run the supply chain from an end-to-end perspective and not in individual silos. So next slide, please. So in short, there are three things that are really, really key and important to remember as we get ready for this restart. And every decision, every action that you make within your company really need to be thought through in light of those three different items. The first one is it's critical to understand and know the company's top priorities for the next few months, right? What are we solving for? Are we solving for cash flow? Are we solving for profitability? Are we solving for market share? Are we solving for to protect key customers? As we will see in just a minute when Aaron shows us the demo, cash flow will be an important criteria to take into account as we get going. But really understanding what we're solving for is number one. Number two, we can't manage the supply chain in silos. We can't manage the supply chain by each individual function. We have to manage it from an end-to-end perspective. That means that we need to have the capability to model the end-to-end and the impact of alternative scenarios and how to optimize those scenarios. Again, not functionally, but from an end-to-end perspective across the entire spectrum of the supply chain. And third, emotions can be very dangerous at this time if emotions drive decisions. What we need is to keep or establish the command center with data-driven decision-making authority so that we don't leave the decisions based on emotions, right? We don't service the customer based on who screams the loudest. We actually service the customer based on sound data and data-driven decision-making. And with that, I will turn it over to Aaron to take us to the next step.
Great, thanks, Pierre. That's a lot of challenges that are coming up in the near future. And I thought what we would do is illustrate during this webinar how you might leverage River Logic's prescriptive analytics platform to address and investigate and help you make confident decisions around the things, Pierre, that you were just talking about. So it all starts with the River Logic prescriptive analytics platform. Now, prescriptive analytics is a form of analytics that looks at complex systems with lots of decisions and lots of interconnectivity and suggests to you the best strategies to meet your goals. And as Pierre was saying, knowing what your goals are, knowing what your constraints are a critical part about it. And we'll talk about how that information gets represented in prescriptive analytics. For River Logic's platform, we base the prescriptive analytics on the idea of a digital planning twin. And essentially what that means is we have a model of your business. In this case, this is an end-to-end value chain. So this is quite a bit more than just the supply chain component or just a manufacturing component, but represents the business from purchases of raw materials all the way through to how demand gets created in your markets, which includes logistics, includes production, includes warehousing, and things like that. In addition to that operational part of the business being very important to the representation used for prescriptive analytics here in the digital planning twin, it's also important, especially given the challenges that Pierre outlined, to understand the financial relationship between those operational processes and your ability to finance them, to generate profit, cash flow, manage your balance sheet, all of those financial metrics, which are equally important, if not more important, during cash challenged times and times when things change very drastically. So let me introduce the digital twin we're going to use today. You see in this picture that there's a diagram, and the diagram flows, as I said, from purchases, which could be raw materials, could be purchased finished goods, or purchased semi-finished goods, where we represent what vendors are available, what volumes are available, costs and terms of those raw materials. Those purchases are then connected in the model to the production steps. So you see sort of a circle of production where you could have multiple production steps, but here's where we represent production capabilities, capacities, number of hours of production availability, number of production lines, what those production lines can do, what their costs and things are. And you can see some of the kinds of things that you might want to include in your digital planning twin in order to have a realistic model of the capabilities and trade-offs that are possible within your business. Moving forward from the inventories, there are logistics and shipping is represented. That means that this model, for example, could have 20 production facilities in at all different locations. Each of those 20 production facilities in this area could be shipping to DCs or shipping directly to customers, or maybe just regions, depending on how you want to plan and look at your data. So there's logistics, there's different modes of shipping. It could be ships, it could be trucks and barges and all sorts of things like that. And then all the way over on the right here of the operational part of the model, we have sales demand. And this is where it gets kind of interesting for the challenges that we're facing going forward, which is we don't know necessarily with a high degree of confidence how quickly the demand is going to come back. So we'll want to be able to test this. We'll want to be able to ask questions about if the demand, if the intrinsic demand comes back at this rate, how much can I capture? How much should I capture? How quickly can I ramp back up production, ramp back up my purchasing, reprime my supply chain, and get to running? And then finally, and this is down at the bottom part of the diagram, you have the financial structure of the business. Now, it's represented here very simply, but there's a lot of power in this, in that each of these objects, production, sales, and the company as a whole, represent a full financial general ledger, profit and loss, balance sheet, and cash flow metrics are all tied in here. And these are connected to every activity that occurs in the operational part of the model. And what I mean by that is when you purchase, for example, and you have terms and you need to pay cash within let's say within a month or immediately, that's all represented down here in the financial model. And you can have constraints and capacity. So you might have a certain amount of cash in the bank. You might have a credit line that has a certain limit to it, et cetera. And they're all tied together in the model so that when you ask questions, all of these things are interconnected and the best solution with respect to both operations and finances can be found quickly. This is an optimization-based model. So it operates off of constraints, costs, revenues, and the objective function, in this case, be as profitable as possible, or it could even be to grow the business as fast as possible and regain market share as fast as possible, or any number of goals that you might ask the optimization to help you find. So that's a little bit about River Logic platform, and I'll show you the platform directly, and we'll actually go through some scenarios, some simple ones that show how that interplay between cash and operational decisions might become a very valuable one to investigate with the Prescriptive platform. In order to do that, let's set up a quick demo. I'll give you the background here. We're starting off with a candy factory. So this is a company called Nutmeg Candy. They manufacture and distribute candy bars. They buy a lot of raw materials. So they have vendors who have to manufacture or acquire the raw materials that they then can sell to Nutmeg. And the major raw materials, the ones that we're worried about, are chocolate and sugar and nuts. Those are the ones that really drive the business, that are likely to have supply problems. As Pierre said, they could be coming online in different countries at different times. Some of these vendors may be cash strapped themselves and asking to work together with Nutmeg to have the best outcome for both Nutmeg and the vendors. That some of them are long term. So the starting point of our demo will be life's been rough for Nutmeg. They have shuttered a couple of their plants. Their demand has dropped off pretty significantly. It's not gone. People are still ordering chocolate through Amazon, apparently. But they have been doing their best to conserve cash. Their inventories have been dropping. They've been using their inventories They do have made a commitment to some of their employees, so they are drawing down cash. As things turn around, here's the challenge. We've gone into the bunker mode. We've furloughed employees. We've shuttered or temporarily shuttered production facilities, and the world is coming back. What do we do to be able to, as quickly as possible, capture the demand as it remanifests itself? So the first thing, and the thing that they've really already been doing, is reducing operating expenses as much as possible. They've shut down a production facility. They're managing cash. They did some SG&A exercises, but they're still using up cash. So as they come back online, there are a couple of other things that they can play with. One is to go to their customers. And so as the demand comes back, they can say to the Walmarts of the world or to whoever their customers are, is it possible that you could pay us more quickly and alter those normal payment terms? Because what happens is if we sell to a company and it takes 30 days for that company to pay their bills, that means we're using up our working capital. And if working capital is short, we've got some challenges that could keep us from being able to produce more product, which would then result in us not being able to meet all the demand as it's coming back. The same exact mechanism works on the payment side. So they have multiple vendors, and that's what we're going to concentrate for this little demonstration. But I want you to sort of have in your mind that it could be any of these. It could be choices of which distributors to use, because distributors have different terms. Moving your product around, or the logistics part of your business. Some of your shipping could actually take longer. That ties up cash as well. Decisions about where to build inventory are other things that influence cash. But we're going to focus on vendors. And here's the scenario. Throughout the years, we've gotten very chummy with vendor number one. Vendor number one has given us the best price. In this case, it's chocolate, at $2.25 per, in this case, per pound as a raw material cost. They are saying that they can meet our demand as we come back online, but they're in a cash crunch as well. And they've come to us and said, look, we can't keep giving you our normal credit terms. We need immediate payment. So we'll look at what that does to the company and how that constrains what can be done. We can work with it, but it does keep us from meeting our goals. But in the second scenario, we'll look at our other vendor. So we do have another vendor available. This is not a vendor that we use extensively, or that Nutmeg has used extensively over the years, mostly because they have higher price. And so whenever possible, we had been buying from vendor one. Well, now with the higher price vendor, they are willing to keep the 60-day terms arrangement with us. And so the question becomes is, do we take advantage of vendor two? What is the impact on our supply chain? Does that have an impact on what we should be selling, how much we can gain a market share, and really ultimately how much profit we can capture as we restart? So I'll pause there for just a second. Pierre, feel free to jump in as we go through this demo to highlight any areas that you think might be of interest to the audience. And we'll jump right into showing you some of the technology.
Yeah, Aaron, I mean, obviously the script here looks kind of simplified, right? We just have two scenarios, one with a vendor, one with two vendors with one at higher price. What would happen if we actually had constraints around transportation or payment terms also on transportation providers and or even the demand, right? So what would happen if we had a multitude of variables, just like I described along the SCORE model, where it's likely that in the restart, disruptions or unpredictability is going to happen from everywhere?
Yeah, and I think that's one of the powers of the Prescriptive platform, is that you can include the constraints and options that are most important to you, and you can add on to those over time. And we are in the cloud here, so we have a lot of computational power to sort through all of those potential options that you're talking about, whether it's which vendors or which shippers, all that sort of stuff. So yeah, it's a great question. Let me sort of give you a quick overview of what you're looking at. We are in the web right now, so this is a cloud-based platform where that digital twin model that I talked through earlier is living. And here's a representation of it in the cloud as well. But this is a place where I can adjust data and assumptions. I can run optimizations. I can create lots and lots of different scenarios and then evaluate those scenarios to decide what my decisions would ultimately be. And within each scenario, when I run the optimization, it's potentially looking through thousands, hundreds of thousands, millions of different ways to run the business, helping you find the one that suggests to you the ways to run your supply chain or who to purchase from that achieve the best results. So it's really a powerful optimization-based planning platform. So let's dive in and see how things look today, and we'll use some of the sort of built in where things are today. This is Power BI embedded in the River Logic platform, and I'm going to start with a quick view of the current month, and I'm going to make this large for just a second so we can see through it. We're looking at what's going on with Nutmeg this month, and we've got a whole bunch of another 12 months coming where we think demand is coming back. But I wanted to show you, first off, we're purchasing only from vendor one. There's a very simple graphic here. We're producing only at plant one. Our second plant has been shuttered. And our sales units are low. Historically, they're much higher than that. And as a result of various fixed costs, production fixed costs, we are operating at a loss. And each month that we operate at this loss, we're using up cash. We're having to reduce our inventories to cover some of that. And our credit line is actually diminishing because our credit revolver is based upon how much material we have in inventory. So as we are trying to conserve cash, we're also reducing our credit availability, which is quite common. In order to run a scenario, I can then change any assumptions and put in add demand, for example, and add vendors. And this is done, and I'll show you very briefly how the inputs work. For this particular scenario that I'm calling cash flow budget, I have a table that I can change data in. In fact, I have a whole list of tables. I won't go through them all, but as you can see, these are the key tables that would provide inputs in this case, and they're all customizable. But in this case, this helps us understanding what our constraints are around production, our costs, our shipping, what the raw materials costs and our vendors are, and how the demand is going to build over time. So these are the critical pieces that I need to have to play around with and to change data and rerun optimizations to come to the answers I want. So now back to our story. If I then take a set of demand, it's going to increase quickly, and I'm going to click over to what that demand looks like with our single vendor, and I run the optimization. This is going to be insights, and I'll go to sales demand versus serviced and make sure that's looking at my entire budget path going forward. So again, I'll make this larger so that you can see it. This is our baseline scenario with vendor one and what we think is going to happen as demand comes back online. The blue line up above is our demand or our market potential. And the red line below, although it's going up and we're building back into our market demand, is not capturing all of that market demand. In fact, the difference between this blue and this red is unmet market demand. Now, why is it unmet? It's unmet because we're out of cash. And every time we sell something down here and it takes a month to get paid, or we have to pay immediately for our raw materials, we don't get the benefit from that sale, the free cash, working capital, for, let's say, a month or maybe 2 months or some combination of that. So as we sell, we very slowly build our cash and redeploy it immediately to buy more raw materials, to produce more product. And we're limited because each month we're spending cash as fast as we've got it, and we're using our full credit line, and we're constrained. The prescriptive analytics platform and the optimization has made decisions to try to do this as well as possible, to capture as much as possible. So we've kept plant one as the only one that's running because we haven't got enough volume yet to run plant two, so that's helped conserve cash. We've made choices about which customers to sell to. We've made choices about which shipping companies to use, but we've still fallen short of demand. So remember that other vendor that's available. What if that other vendor were available? They're much more expensive, but they're going to give us some terms, so that's going to have an impact on how quickly we get cash. Should we use that vendor? When should we use that vendor? How much should we use that vendor? And if we do use the vendor and answer all those questions, what's the impact on production? Where should I be making things? How should I be shipping things to market? And then overall, if I can't reach full demand, which demand do I meet? Which customers, which kind of products should I sell? And all of those very complex, intertwined questions. So we go back to our inputs, we add that vendor in, and we run the optimization, and that's the second scenario I'll click on here we've already run, which is our cash flow optimized scenario. So this is a scenario where we're looking to use that second vendor. We're asking the question, what would be the impact? How should we run the business in order to use that vendor? Well, good news, Pierre. We have come much closer to meeting market demand. We're still somewhat constrained, but we're doing a whole lot better deploying our cash and being able to meet demand. And that's a significant difference. We went from perhaps meeting about 30% of demand towards the out periods to now meeting, looks like an average of about 90% demand as it really comes back full steam. So I think one of the questions, I know, Pierre, you had this question about the products and what's really going on down here, right?
Yeah, because you mentioned, I mean, the optimizer also determines which customer to service, right, based on what it makes sense to do. But what about products?
Right. That's a great insight. You see, we're not meeting all of our demand, and the model's saying that we can capture about 90% of our demand, but which demand are we actually capturing? And so I have a filter here for our product families, and we'll drill into that. Let me just pick, let's say, family number 1, and I've got family number 2 as well. Ooh, that one goes flat. So what it's showing is that family number 2, we're meeting 100% of demand in this optimized plan going forward. So that would be a indication to me that that's our best product. That's the one that has the least impact on our cash flow, or is most favorable for cash flow, allowing us to generate cash faster than the other product. And it's profitable as well, because we're looking at profitability, and I'll show you that as we click through some of the reports we get. The other product family is where all of the miss is. So we're unable to continue to sell the other product. Not unable, but it's not the better product to sell. And you can see we're only meeting about, it looks like 56% of family 1's demand in the out months. That's the dip right there. So the average is probably closer to 60%. And that outcome is actually better than if we had met all of the demand in this family and less of the other. The optimization has actually shown us that that's the better one for cash flow. And what that really tells you, as you're all supply chain experts out there saying, gosh, this decision I make on raw materials with regard to terms, right, my vendor terms, is really impacting about what I should do in terms of selling which products as the market comes back. And at the beginning of the discussion, we talked about the value chain, the whole, end to end, all the way from vendors, all the way to opportunities and demand needing to be part of this overall view and analysis. And Pierre, you mentioned, that not having silos is going to be critical here. And this is probably a great example of that.
Well, I think what this also shows us is that if we were running the business based on emotions, and we were listening to the sales reps say, no, my customer has to be serviced. No, this customer with this product needs to be serviced. Then we could do that, but they would have a negative impact to the optimal scenario, and then we'd be able to actually quantify the impact of that particular decision if we were to change some of the parameters associated with customers' demand.
Yeah, we could run a scenario where we force the other product to be sold, and we look at the impact on cash and the loss in profit. And just like you say, you can have that discussion with the market team, and now you have a quantified answer about why you shouldn't go after that product. I think that's very powerful. So let's look at really what's going on with our vendors and how that choice was made. So I'm going to flip back to a chart that shows what how I'm purchasing by supplier. And let me set a few things. Let's go back to that budget case and let's look at over time. So remember in the budget case, in the starting case, I was just using vendor 1. Vendor 2 is not doing anything. Plant 2 is shut down. All the actions happening in plant 1. And you can see over time that I am buying more. Remember, we were able to capture some of that ramp going up, but we were cash constrained, and because of it, we couldn't capture all of the demand. Well, when vendor 2 comes along and we consider vendor 2, some magic happens. One is that, as you know, we start catching a whole lot more of the demand. You see that plant 2 has now come online. In fact, the optimization has dedicated vendor 1 to plant 1 and vendor 2 to plant 2. And the real interesting part of the story is the graph over time down below. What it's showing is that we're starting off with vendor 1 almost exclusively, and we're bringing vendor 2 online very judiciously. And that's because of that positive impact on cash. We don't want to bring vendor 2 online all at once because they're a much higher cost vendor. So if we don't need yet those terms, we're not going to focus yet on vendor 2. In fact, it's not until, it looks like until June or so, that we actually are starting to favor vendor 2 and give more of our business to vendor 2. And that broadens over time. So this is a great example of why this is a complex problem and why the prescriptive analytics platform really can give you some of the insight that you might not be able to get just by sort of thinking through the problem end to end. Okay, this is a great story, but we have now really upset at least one part of the organization at Nutmeg Candy. And you're gonna guess who we're talking about. That is the purchasing manager. So let's look at the purchasing manager's KPIs just to get an idea. And I think you can see this. You can see this coming. We'll focus on the 2 scenarios we've got here: a cash flow optimize and the cash flow budget. So the budget was the starting one, and the optimize is where we bring in vendor 2. The key illustration here is this chart down below. This is basically the purchasing team's KPI. And their KPI has been, that's the dotted line that's in the middle here. Their KPI has been that they're targeting cost of raw materials as a percentage of sales around 56%. So that's a cost metric. And what that captures is that as their raw material costs go up and as their marketing team is able to raise prices, they try to shoot for a pretty standard percentage as their cost. And with vendor 1 only in play, that base scenario, the blue line down below, you see they can stay below their target their target percentage of purchases to sales. When we bring vendor 2 online, that blows that KPI out of the water, meaning this is bad. I know it's going up, but up is bad in this case. And it's a large percent. You can see that the cash flow, that the cost of raw materials as a percentage of sales is going up about, looks like almost 8%. Maybe it actually looks like a little more than 8%. And that's a big hit on a KPI. So I don't know, Pierre, what do you think? How is this team going to react to this, and how do we manage this?
Well, I mean, we have a few options, right? One option is that we could say, no, the sourcing team and the metric rules everything that happens within the company, and therefore we need to stay at 56.43%. And we kind of know what the result of that would be for the overall cash flow and profitability of the business. Or we could say, look, let's just manage the business like it's an end-to-end and not, isolating at the function and do the right thing. And in which case, then, yes, that's true. The sourcing manager will say, hey, but you're impacting my own metric. That's right, but it's for the greater good of the company, therefore that's what needs to be done. So there needs to be a reset of the metric for the purchasing manager, because obviously we don't want to be staying at the green line, we want to be at the black line.
Yeah, and luckily we have all of the data here to sort of illustrate why that's so we can support that decision with what is the impact on production, what's the impact on distribution, et cetera, all throughout the business. So everybody's KPIs could potentially be changed, but by seeing the entire business, you can say, well, that's okay. We're going to accept that KPI being up high now as we come back online, and we'll retarget it low again once we're in a better cash situation, once we're sort of more stable in the market. That may be a while, right? You said earlier things could be jumping around for quite a bit.
It could be a while, yes. We could be looking at this and having to rerun scenarios almost every day or every week, right, for a while. Yep.
Exactly. So let's take a quick look at just how valuable, in this case, this is for the company. I'm going to pop over to a pure financial comparison. And you can see I'm going to compare the two scenarios that we just ran. This is a profit and loss statement along the right. Gross sales is at the top. So this is the revenue coming in. Then we have some production costs down below, including labor, materials. Here's the purchases line that we talked about. Variable processing, fixed processing. That's one of those things that was driving the the consumption of cash that they just couldn't get rid of without selling off plants. Depreciation, cost of goods, all the way down to net income, which is the profit number down below. And what you can see is clearly, and we showed this in the graph, that we're able to capture a lot more of the market. So we go from $779 million to $1.68 billion in sales for that trailing 12 months that we're investigating. Now, the demand might not come as fast as we put in the model, so it makes sense to run lots of scenarios, maybe an upside, maybe a downside. And one of the powers of the cloud platform is that you can do all that. You can run hundreds of scenarios if you want to see what the impact is and really understand what your strategy levers should be as you learn what the world is going to be like. So that's the improvement in revenue. Now, our costs did go up drastically, where the revenue went up 114%. Our cost of raw materials, of purchases, went up 142%. That's a lot higher. You'd expect it to only go up about 114%. But that's due to that higher priced vendor. Well, the good news is that still allows us to increase our profit. So in this case, we go from a net profit of $43 million to almost double, well, not quite double, but $93 million, 113% increase. I'm sorry, more than double, 113% increase. So that really shows the value of, even though you're spending a little bit more money, all of the other impacts on the supply chain, what it allows you to do in the market, has that overall benefit, where your goal here is to capture as much of the market as possible, which is that top row, and to do that profitably. Pierre, as you said at the beginning of this presentation, how do we come out of this and do it profitably?
Right, and this also is a good, it shows well that what I described earlier in regards to don't let emotions run the business, right? Make sure that it's data driven. Well, there's no better data than actually showing the impact on the P&L, right? So they can go up all the way in the organization outside of supply chain into the finance group to say these are the decisions that we need to make, because look, this is the impact on the P&L. Otherwise, we would just be guessing if we didn't have that visibility straight into the financials from the model itself.
Yeah, absolutely. And I think, one of the things that I've seen over time is that you have different stakeholders in different parts of the output from the model. Some people will be very focused on the operational, what's being made where, how am I buying, others on the financial. And you'll get some, real financial folk, the CFOs and things like that, who would want to look at not only this P&L, but also what does the cash flow actually look like? How is my working capital changing? And all of these are available in the platform. The balance sheet, priming the supply chain, where's my inventory going, and all that are all available. So everybody gets to see the parts that they really want to focus on, all in the same tied together model that all hangs together. Okay, so that is the presentation that we wanted to show of the technology. I think before we jump into some questions and some insights, folks may be asking questions about what does it take to do this. So let me pull up go to the next slide here. This is an example of what could happen in a very quick 4-week project with our Prescriptives platform. Within 4 weeks, you have the ability on the River Logic platform to populate a model and a set of scenarios, import that into the data system, and that's very straightforward. We have some powerful tools to do data imports where you can start quickly using spreadsheets and desktop tools, all the way to a full integration capability as you, once you start getting value out of this and move forward and start using it in an ongoing way, you may want to do full integration. You can be scenario modeling, meaning running what ifs. And that's where you start to generate a huge amount of value. You see a little star here that says value capture. Within 2 weeks, being able to generate value, run what ifs, see results, and start to get some of those insights about maybe I ought to consider vendor number 2 as part of the process. And then within the next couple of weeks, spending a lot of time about some of the things that Pierre was talking about, how you take those insights, how you communicate them, how you roll them out in the organization, throughout the different traditional silos and all that sort of fun stuff. Can happen very quickly. I don't know, Pierre, if you wanted to say anything about this. We work with Pierre's team on this all the time, so you may have some insights as well.
Well, yeah, the key is not to try to solve world hunger from the very first model and from day one, right? Otherwise, we'd be spending more than 2 weeks before we have any value. The key is also not just to focus on one scenario like the one that you just walked us through between the 2 different vendors. Obviously, there's more complexity than that. So it is complex. I mean, otherwise we wouldn't be needing this capability. We wouldn't be doing this demo today. And then Excel spreadsheets and brute force would make it work. It is complex, but if you do it right, and if you think about the major pain points to solve out of the gate, and what data is required to solve those pain points, and you build a model, and then you iteratively build a bigger and bigger model with more complexity over time, then you are able to extract value, like you said, in overall 2 weeks. And I think I've been also very impressed with your ability to be able to get some of the accelerators in place where there are tools that have been already built, models with Alteryx, for example, to be able to quickly extract data out of OS systems and be able to convert it into what's meaningful to be able to be used in the model itself.
Yeah, absolutely. And one of the things that we've seen happen is folks who are listening to this presentation might be thinking, well, I don't have a vendor problem. I got one vendor. I'm all set with the vendor, but my issue is going to be around training employees, getting my employees back, and getting my production facilities up and running. Or maybe it's around getting the supply lanes working to the distribution centers. Pierre, you were sharing some stories about people worried about having capacity, shipping capacity as things come back online. Whatever it is that you want to investigate and really look into deeply can be where you start, right? That's where you need the data, and you can add the complexity as you go along. So that's a great point. So off to you, Peter. I know you had some things Pierre, some things you wanted to say at the end here.
Yeah, thank you, Aaron. I mean, obviously, it's a great demo. Really, always happy to see that. There's only 3 things that you're going to remember from this presentation. I surely hope that there's going to be more than 3. But if there's only 3 things you remember from this presentation, is that number 1, you can't be doing this in a vacuum. You can't be solving for whatever problem you have without having top financial priorities. Right. So what are those financial priorities? Was it cash flow? Is it profitability? Is it market share? Is it whatever it is? It needs to be very clear, because that's the most important imperative to start the discussion. The second, as Aaron showed you, that Excel spreadsheets and brute force are just not going to cut it in this environment of the COVID-19 restart. There's just too many variables, too many potential disruptions all at once, and so you really need to have end-to-end supply chain scenario modeling. And once you have the models that translate into the financial statements, you're able to have decision making that is data driven and not driven based on emotions. And please, again, let's not dismantle the command center that has been established, which is cross-functional to be able to deal with the COVID-19. Let's not dismantle it, but in fact, let's keep it and let's enhance it, so that you really have that command center, which is cross-functional, not with a specific metric within a separate function, but overall metrics that you can use for the end-to-end supply chain. And that's what Aaron and I had for you today. So Shannon, at this point, we'd be more than happy to answer any questions that have been asked.
Yeah, we're getting a lot of really great questions. I know this is supposed to end at 10:45, but we'll keep it going until the top of the hour just to address some of some of the questions that have come through. So some of the things you've already addressed, Aaron, questions like how complicated is this for a global company that has, a really widespread production? And then another question is around how complicated this is. How do you get the financial information into the models itself?
Mm-hmm.
So let's address a couple of those at a high level.
Sure. I think for a global company, as Pierre was saying, you probably don't want to boil the entire ocean right off the bat. Luckily, the way the system is set up is you can build models at higher levels if necessary. So an example might be, simplifying your production facilities or thinking of your products as product families rather than individual SKUs. These are things that, if it makes sense to do, you can do data aggregation into the model. And we see that happening, fairly commonly to get people started, get some really good answers right off the bat, focus on what you need answers for. I think that most people have a pretty good sense for what the things are that drive their business, and those are the things really to focus on, especially the things they believe will have an impact in the restart. I don't know, Pierre, if you have any more comments on that.
Well, like I said, I mean, you don't want to boil the ocean. It is complex, but the key is to break it in smaller chunks that can be managed and they can be modeled one by one, and then you can kind of add on to that. So again, the timeline that you have shown, whether it's 2 weeks or 3 weeks, again, depending on the size of the company and the global nature, I mean, we've done it in that amount of time. So it's very, very doable, right?
Yeah. And as for the financial information, in the case of what I just demonstrated, the key pieces are the ones that were in there. So in this case, it was how much cash was on hand in January, how big is the credit facility, what are the status of all of the inventories and the things that drive cash flow. And it was really just a handful of things that needed to be modeled in order to understand this insight. So you don't need to have every single general ledger line item in your financial model, but the key drivers. So that can simplify and speed up the process of getting answers very quickly.
Great, thank you. So here is another question. So one more, people are apparently pretty interested in the financial aspect of this. So for financial projections, arriving at cash flow, does the software recognize incremental and marginal expense calculations, classifying the capacity of the resources as sunk, fixed, semi-variable, and variable?
Exactly.
Oh, excuse me, semi-fixed and variable. Yeah.
Yeah, those are all the categories. So when you're building that operational part of the model, you're not putting in average, cost of goods sold. You're actually putting in what is the fixed cost, what's the variable cost, what's the marginal cost of things. And you can, that's not hard to do. It's sort of a zero-based or bottoms-up approach. And in general, it's just asking the question, what is the variable cost of production? What's the variable cost of purchasing? The variable cost of shipping? And what are the various fixed costs as well? You can get very detailed if need be, but the same things that we just talked about apply where you want to start simple versus complex. I can tell you that the River Logic platform has the ability to do financial modeling in a great amount of detail. So if you wanted to get very fancy, you certainly could. A very good financial modeling system.
So on the topic of the modeling, how do you handle variability in the model? The scenarios appear to be deterministic and don't take variability and randomness into account.
Yeah, great question. As I mentioned, because we're in the cloud, we have the ability to run lots of scenarios at once. So stochastic modeling techniques of saying, my demand is going to vary, allow you to run large numbers of optimizations to look at variability. Within individual model runs, you can also do sensitivity analysis on the variables that are key to you. So what if my demand was off? Would that have a big impact on my bottom line? So you've got a bunch of tools in the Prescriptive platform to address variability, all the way from those sort of stochastic and Monte Carlo style analyses to really powerful sensitivity analysis within optimizations.
Right, and that kind of addresses a separate question that can you run scenarios that vary more than one variable at a time, or do you just change one variable at each scenario? So that's addressed in your response. Let's talk about solve times. So how long would it take for a solve?
A typical sort of tactical model, the kind that I was showing you with a few hundred products and half a dozen production facilities and distribution centers sprinkled around the world might be 2 minutes. There is no sort of complexity limit. So as your supply chain, end-to-end supply chain gets more complex, those solve times can get longer. But really, because they're in the cloud and you can queue up multiple solves in parallel, you have a lot of ability to do a lot of analysis really fast, even if the individual solves take more than just a couple of minutes. They take a half an hour or something like that. But just a few minutes is usually the typical for this sort of thing.
Perfect. I'm gonna take one more. We've got just 4 minutes left, so one more for you, Aaron, and then I've got 1 or 2 for Pierre. This is a good one. How far ahead, how far forward can you look when you're looking out on your planning horizon? Months, years, decades?
Sure. Well, if I said as far as you like, that would sort of beg the question. I mean, there's no limit in the platform. I might say as far as you believe, but we have companies that do, or customers that do through our partners, like Accenture, that have multiple planning cycles. They might have a 30-year plan. They might have a 18 or 24-month more tactical plan, and they might have a weekly plan for the next quarter. And those could all be based off of the same model, of course, different data and different resolution in the data. But there really is not a limit. If you believe you have good assumptions data out a long time, go ahead and build a model around it.
Which kind of is a good answer for, again, normal operations. I'm not sure that if we were to look at the historical demand over the last 2 or 3 months, that would be a good predictor of what the future demand is going to be over the next 12. And so, again, in light of this COVID-19 and the restart, I think one item that has not really been mentioned too much in the questions is the demand, which is not as scientific as art, because now it's really all about trying to figure out, well, what do we think the demand is going to be? Because if we have bad demand and we have all the right assumptions and everything flows into the financials, the model is not really going to be able to tell us really what is. I mean, it tell us what could happen under those scenarios, but it's not really going to be close to reality. So I think a lot of the effort needs to be done on making sure that we really have a good grasp of what the demand is going to look like. And like I said, I think that's more art than science at this point.
Yeah, and you can run lots and lots of scenarios, so you're not sort of locked into one sort of view of the future. Right.
And let's, Pierre, I think this is a really great one for you. The biggest barrier to being able to do this, is it technology? Is it a tool? What is your opinion there?
Oh, it's certainly not the technology, and as Aaron just showed us, it's not the tool. I mean, obviously it's the change management, right? Supply chains have been, for the last 25 years that I've been in supply chain, maybe even longer. Supply chains are kind of run in functional silos, right? You do have the sourcing team with its own metrics. You have the logistics team. You have the production team. You have logistics and so forth. And when you start thinking about end to end, there will be winners and there will be losers. And at the end of the day, what you're trying to solve is for either the cash flow, the profitability, or whatever other key performance you're tracking, but for the end-to-end enterprise. Because if you start thinking about it in functional silos, you're not going to be able to optimize the end-to-end. And so the biggest barrier is to actually convince people that my metric is not the most important metric in the world, but actually the company's metric is really what matters. And so really it's a change management impact. Of course, that's under normal business conditions, as we can see in the COVID-19 and the pressures that we've had, the companies have had, especially on cash flow, and will have for the restart. I'm hopeful that some level of change management will not necessarily be necessary. That a lot of people kind of realize that, hey, we're all in this together and we're solving for the end to end. At least for a while before everybody kind of goes back to their own individual silos. So change management is the number one barrier to successful implementation and planning for the restart.
Great, thanks for that. And that kind of addresses one last question about scalability. So how well can the technology handle a complex supply chain with dozens of suppliers, dozens of plants, distribution centers, hundreds or thousands of products? So the technology there is not the limitation. So it's very scalable, but it's more how complex is the change management at that company, right?
Yes, that is correct. That's correct. Technology is not, it's not the barrier, right? It's actually the people behind the technology that could become the barrier. And hopefully that will not be the case here with the restart.
Yeah, and I think when you said earlier, Pierre, not to boil the ocean, it's not because you don't have a big enough cloud that can solve the problem. It's because you have to get all that data together. You have to understand it. You have to be able to interpret and implement on the results and all of the different complexities of it. And so sometimes boiling the ocean is what makes that change management that much harder, right?
That's very
more complex.
All right, great. Well, we're 1 minute over. We still have a couple unanswered questions. I'm sorry we couldn't get to those. We'll make sure to follow up via email to every single one of you individually. Thank you, Pierre and Aaron. That was a really wonderful presentation, and thank you to everyone who's joined. And I hope you all continue to stay healthy and safe throughout the rest of the crisis.